Hello and welcome to this edition of the video market update from Orbex.com. So the US jobs report for the month of June came in with mixed outcomes. The US economy added more than 222,000 new jobs in June, which is higher than the 175,000 estimated. Yet this was also the only positive outcome of this report. The unemployment rate ticked higher for the first time in 4 months. As we saw for the past 4 months, the unemployment rate was declining gradually, reaching the lowest level since the financial crisis, supported by the falling participation rate. In June, the unemployment rate also ticked higher as the participation rate also increased, but the people who went back into the labor force couldn't find the jobs that they were looking for. And the question remains now, if the participation rate kept rising over the next few months due to the notable rise in the consumer confidence index, will the unemployment rate also continue to rise side by side with the participation rate, or will it go down again? And this is what we all be watching in the next few months. If the unemployment rate also ticked higher further in the next few months with the participation rate, this keeps on telling us that, or this means that the US economy is still unable to secure high quality jobs as of yet. On the other hand, the wages came in with another disappointment, rising by 0.2% on a month-over-month basis, despite the fact that estimates were to rise by 0.3%. Moreover, the previous reading for the month of May has been also revised lower. The year-over-year wages also remained stable at 2.5%, despite the fact that estimates also were to rise or to tick higher toward 2.6%. Despite the mostly negative jobs report, the US dollar was able to breathe finally a little bit, but remained near the lowest level since October of last year, and we will talk about it, of course, later in this video. As for the week ahead, this week is likely to be very calm during Monday and Tuesday, with lack of fundamentals across the board, while volatility is likely to pick up again by Monday, as we all will be waiting for, first of all, the UK jobs report. We have also the Bank of Canada decision. But most importantly, Janet Yellen is due to testify on the semi-annual monetary policy report before the House Financial Services Committee in Washington, D.C. As for Thursday, we will be all waiting also for some inflation data from the U.S., including the PPI and the core PPI, in addition to the second day of Janet Yellen testimony. And finally, we will be watching also two of the Federal Reserve members' remarks, including Evans and Bernard's. Finally, on Friday, it is all about the US once again, as we'll be waiting for a lot of inflation data, including CPI, core CPI, whether on the monthly basis and also year-over-year basis. In addition to that, we'll be waiting for the retail sales data, industrial production, capacity utilization rate, and the initial reading of the University of Michigan Consumer Confidence Index. So this is it for the fundamental part of this video. And now let's have a look at the most interesting chart for the week ahead. Beginning with the US dollar index as always, and again, last week it was another week with a failure to break above the resistance area, which is 96.50s, and on Thursday it managed to break all the way back down, but on Friday it was just a slight lift all the way to the upside at 96. And so far, as long as we continue to trade below the 96.50s, so far the bearish outlook is here to stay with no signs of any kind of retracement to the upside for the time being. However, any kind of retracement to the upside, and if it breaks above the 96.50s, we would expect like another upside probably around 90s, 96.90s and 97.20s, which would represent the trend line resistance on the daily chart. Plus, don't forget that we have like most of the moving average right now are pointing lower, especially the 50 and the 100, and we have a clear death cross to the downside on the daily chart, which keeps the bearish outlook unchanged for the time being. At the same time, a break through the 95.40s, 95.50s, this would clear the way for another leg lower, probably toward 95.10 and 95, which is a very significant level to keep an eye on over the next few days. Going forward, also to one of the most interesting charts that we have been talking about for the past few months. After more than almost seven weeks of gains, finally the New Zealand dollar also gave up a little bit of some of these gains, but at the same time, it seems that we are on the right track once again. And so far, we haven't seen any kind of like clear break above the resistance area, the one that we've been talking about for the past also since the beginning of the year actually. And it's been a year right now, since the Kiwi has been trying like to break above this area. But so far, as long as I mean, if you look at the area just like this, as far as it continues to trade below this area, which is around, we're talking about 93, 94 and 73, 94 and 73, this would keep the bearish outlook unchanged for the time being, especially that technical indicators are also on our side heavily overbought on most of the time frames, and also on the weekly chart, which basically would give us more signs that another downside retracement is highly possible. So that would be an interesting move for shorts for the time being, with stops above the previous highs, which is around also 97.50s. Oh, sorry, 73.50s. Okay, going forward to the LZ. The LZ made it also, it was even more clear because it was a little bit lagging, but at the same time, it's pretty clear now that also the resistance area remains very solid. We tried to break above the resistance area, or the resistance area between 76.70s and 77.20s during last week, but we failed to do that, and then it breaks all the way back lower. Don't forget that we have also this week some Australian data, but at the same time, we still believe that more downside is probably possible towards 75.30s in the next few days. Technical indicators are on our side, heavily overbought, and at the same time crushed to the downside. This is more clear than even the Kiwi, but I would still I'm favoring both Kiwi and the LZ for more downside. As for the euro, and despite the slight decline that we saw on Friday, it is still positive and still bullish on most of the time frames, whether the weekly or even the daily. But we're stuck actually for the time being around a very significant level, which is the 114 area. 114 is very important because, again, it's a former resistance area since almost, we're talking about since March of 2015. And this is a very important level to keep an eye on over the next few days, as a break above that resistance would clear the way for a huge bull run, probably toward even the 117 over the next few days, or even over the next few weeks, probably this month. But we still also, any downside retracement is likely to be capped above the 113, I believe, and 113.50. That will be the levels that I'd be interested to keep an eye on, especially the trend line is also trading around the 1270s and almost 113. Going forward also to the British pound. The British pound also failed to break above the 130 level over the past few days. Again, the G20 wasn't really good for the UK because they couldn't even agree on any kind of free trade between the UK and the US, and even with the EU. Still, the tensions are still rising for a hard Brexit and a complicated negotiation. So at least we tested the 50-day moving average. Right now we have kind of some sort of like a double top formation on the daily chart, which basically supports the idea for another leg lower in the next few days, despite the fact that, again, the US dollar index outlook is still bearish, but still the British pound is unlikely to be very positive over the next few days. Even though that the Bank of England is looking to withdraw some of its stimulus, but still we're not sure when they will do that. But I still believe that there's still some sort of a chance for another leg lower toward 128, 128 or 128.04 or 128 or even 127.30s. That would be still highly possible. Going into the Japanese yen, we had like it was a little bit surprising for us. It continued some sort of like a ladder on the daily chart and continues to rise like steadily over the past few weeks, breaking above a notable resistance. But at the same time, the trend line also has been broken right now, which basically clears the way for further upside. The final level that we'll be watching for an invalidation for our bearish outlook is basically the 1430s right now here, which is like very it's just like around like 50 pips away from here. Technical indicators are heavily overbought, so we're with a little bit like crossing to the downside. That's why there's still a possibility for just a slight pickup before the downside trend resumes. And we still believe that the moving average might be the level to look at, which is around like 111, 111.60. So we'll keep an eye on the dollar yen over the next few days, not to break above the 14.33. Gold, despite the fact that there was many signs of the U.S. dollar weakness, and despite the tensions around the world, also gold slides actually back down, and now we don't have what or the formation that we were talking about, which is a higher lows. Right now is actually kind of a lower highs on the daily chart, whether from the top that we saw at the beginning of June or mid-June until today, but looking at the Fibonacci retracement from the bottom of this year until the top of this year, right now we're closing around the 50% Fibonacci retracement, and it actually it was a good reaction, despite the fact it's very minimal, but it is still a good reaction. At the same time, there's still a possibility right now to test the $1,200, which is around, I guess it's here. Yeah, which is the former support, and also it's within the area, or within the support area on the daily chart. In addition to that, it's also within a retracement area between the 50 and the 61.8. That would be a possibility for a buying zone around this area between the 1190s and also the 1230, so 1213, sorry. So I would still keep an eye also on gold, not to go below the 1190s over the next few days. Silver had a flash crash on Friday morning. So far we don't have any kind of information why this happened, but it seems to be whether of two things: the fat finger and or a trading error. We actually most of the trading platforms, even Reuters, even Bloomberg, showed the same lows around like 1440. But as we said also last week, there was the risk on more the downside more than the upside, but we didn't say that it's going to be like a flash crash like this. However, we're still going to be just watching right now silver. We're not going to look at it like we're not going to see any kind of like trading opportunity right now, but still the risk on the downside. But I would prefer to stand aside away from silver for the next few days until we see some sort of opportunity, or at least some sort of a change in the current volatility, or change in the current momentum. This is it for this week. Thank you for watching also this week's video. If you have any questions, please leave them below, as always, below this video on YouTube. Also, you can share this video on your social media platforms. Subscribe also to Orbex channel on YouTube to get the latest. Thank you for watching again. I'll see you once again next week. Have a good one.